while the screens flash headlines saying, "The economy is growing." Why are you checking your credit card limit at the grocery checkout? Today, we're going to examine the real debt machine hiding behind the strong consumer story you've been told. Is the consumer really strong? Every month, we're told the same thing. The consumer is still spending. The economy is strong. But what if that's answering the wrong question? What if people aren't spending because they're strong, but because they can't stop borrowing? Credit cards, auto loans, buy now, pay later, student debt. If the paycheck is already split up for medical bills before it even hits the account, does that really show a strong consumer? Or does it show an economy propped up by debt that only looks strong? Because sometimes the most dangerous moment for an economy isn't when people stop spending. It's when they have to keep spending just to survive. The modern economy is built on consumers. This sounds completely normal, almost harmless, until you actually think about what it means. Every time people buy groceries, buy gas, buy clothes, furniture, a car, medicine, a digital subscription, a plane ticket, a restaurant meal, or childcare, businesses earn revenue. When businesses earn revenue, they hire workers, pay suppliers, take on debt, report profits, and reassure investors. Consumer spending isn't just shopping, it's the engine of the economy. As long as the consumer keeps spending, Wall Street relaxes, GDP looks better, corporate profits feel more secure, politicians breathe easier. Retailers talk about demand, banks talk about credit growth. Economists call this resilience. But in real life, resilience can mean something very different. It can mean grocery prices getting charged to a credit card. It can mean the car payment gets made, but the electric bill gets put off. It can mean daycare, rent, insurance, gas, and food costs arrive one after another, leaving the family no room to save. It can mean 4 small buy now, pay later installments spread across 3 different apps, none of them looking dangerous on their own until payday comes and the money is already gone. Economic reports call this consumer strength. In real life, it feels like running on a treadmill that charges interest. In the first quarter of 2026, U.S. household debt reached roughly $18.8 trillion. Within that, mortgage debt stood at about $13.19 trillion, credit card debt at about $1.25 trillion, auto loans at about $1.69 trillion, and student loans at about $1.66 trillion. Nearly 5% of household debt was in some stage of delinquency. This doesn't mean every household is on the edge of bankruptcy, but it does mean the consumer economy is carrying a massive obligation into the future. During the same period, real average hourly earnings, adjusted for inflation, fell over the year leading up to May 2026. Simply put, wages didn't gain as much value against inflation as they used to. In the first quarter of 2026, the economy grew at an annual rate of 2.1%, while the consumer spending estimate was revised down to 0.5%. That's exactly where the contradiction lies. The economy can keep growing while households feel weaker. Spending can keep rising while people feel poorer because when prices go up, the total amount spent grows even as living standards fall. When groceries get more expensive, a family spends more. When insurance rises, they spend more. When rent rises, they spend more. When childcare takes longer, they spend more. As a bigger share of income goes to spending, the total figure grows, but nobody feels richer. Everyone feels squeezed. The economy sees dollars moving. The household feels dollars disappearing. Credit is not a new invention, but its role has changed. In the 1920s, installment plans helped Americans buy cars, radios, furniture, and household appliances. The promise was simple: modern life now, payment later. This idea became one of the foundations of the consumer economy. You no longer had to wait until you'd saved up the full amount. You could pull your future income into the present. After World War II, consumer credit expanded even further. Store cards, auto loans, mortgages, and finally credit cards made consumption a permanent part of middle-class life. The credit card was especially powerful because it made borrowing feel ordinary, convenient, and invisible. You didn't have to go ask a banker for money. You just had to swipe your card. First, credit helped people buy more things. Over time, credit became a tool that helped people simply get by. That's exactly where the shift happened. Debt stopped being just a tool for big purchases and became the bridge between wages and the cost of ordinary life. And that bridge started charging a toll. A credit card doesn't close the gap between income and expenses, it just turns that gap into a payment plan. The cost of food still has to be paid. The cost of gas still has to be paid. The cost of an emergency car repair still has to be paid. The only difference is that this gap is now deferred into the future, along with interest. That's why credit card debt actually tells us a lot. This isn't just about people buying luxuries they don't need. That explanation is too easy. The system blames the individual while ignoring the structural problem. Yes, some people overspend. Yes, personal choices matter. But that's not the whole story. For many households, credit cards aren't financing an imaginary lifestyle. They're absorbing ordinary shocks. A broken tooth, a missed shift, a rent increase, a car repair, a medical bill, the end-of-month grocery run. The problem isn't that people are borrowing to live like kings. The problem is that the cost of a normal life has moved beyond what many incomes can comfortably cover. Then came, buy now, pay later, BNPL, systems, one of the most brilliant financial inventions of the modern consumer economy, because it doesn't feel like debt. It feels like a design choice that a button appears at checkout. Split this into 4 payments. No big number, no old-school loan officer, no shame, no long form. Just a clean interface and a message. You can still have this. That's exactly where the genius lies. BNPL doesn't eliminate debt, it turns debt into a user experience design. In 2025, Fed researchers estimated that BNPL providers originated roughly $156.7 billion in consumer credit products in the U.S. Roughly half of that came from pay-in-4 plans alone. More than 60% of total issuance carried a 0% APR, which sounds harmless, and used carefully, often is. But the real danger is psychological. A $120 purchase becomes $30 due today. A $300 cart becomes 4 smaller decisions. The household doesn't feel one big debt. Instead, it feels small future obligations spread out over time, hidden inside apps, and automatic withdrawals. The moment of purchase becomes painless, but the future keeps getting more crowded. Once again, modern capitalism found a way to turn survival into a checkout feature. Then come auto loans. In much of America, a car isn't a luxury, it's the only way to get to work, drop kids off at school, reach the grocery store, the doctor, the warehouse, a second job, or daycare pickup. For millions of people, transportation isn't optional. As cars get more expensive, and insurance, repair costs, and interest rates all rise, the car payment becomes a new price of admission to economic life. In much of America, the car payment isn't a lifestyle choice, it's the price of being employable. So the household debt machine isn't really about desire. It's about being forced to participate in the system. You borrow to get the car that gets you to work. You work to make the payment on the car that gets you to work. The system calls this normal. But normal can still be a trap. Put it all together, and the paycheck is no longer the start of freedom, it becomes a distribution schedule. The landlord takes a share. The bank takes a share. The credit card company takes a share. The auto lender takes a share. The student loan servicer takes a share. The insurance company takes a share. The utility company takes a share. The childcare bill takes a share. The BNPL apps make their small, quiet withdrawals. By the time the worker sees what's left, the economy has already taken its cut. The paycheck is no longer the beginning of freedom for many households, it's become the starting point where everyone else lines up to collect what they're owed. This is exactly the hidden structure of the consumer economy. People aren't just earning income, they're servicing claims on their future income. Every monthly payment is a small piece of tomorrow, already sold. This is exactly where the moral language turns ugly. When households keep spending, they're called resilient. When they fall behind on payments, they're called irresponsible. Think about it. The very economy that depends on consumers spending under pressure, inflation, debt, and rising fixed costs turns around and blames them the moment they can't keep up. When consumers borrow, it's called demand. When consumers can't pay, it's called personal failure. That's exactly where the trap lies. The system needs households to keep spending because consumption keeps GDP, corporate revenue, tax collection, employment, and market confidence afloat. But when income doesn't cover the cost, the financial sector steps in and offers a solution. Credit cards, auto loans, payday loans, BNPL plans, student loans, home equity loans, medical payment plans, refinancing, debt consolidation. Any failure to pay a debt turns into a financial product. And every financial product creates someone else's income. Banks earn interest, credit card companies earn fees, retailers preserve their sales, BNPL companies earn transaction fees and financing income. Auto lenders keep car sales moving, Wall Street gets to package and sell consumer debt, corporations keep their revenue alive, and the government ends up with an economy that looks healthier than households actually feel. The consumer gains access, but that access comes with a leash. Every time wages fail to cover prices, the financial sector offers a bridge and then charges a toll on that bridge. Debt is never just about money. Debt changes behavior. It limits choices. It makes losing a job terrifying. It makes people tolerate things they would otherwise refuse. It makes risk expensive. It turns future labor into collateral. History knows this well. In ancient societies, debt could bind farmers to their creditors. In feudal systems, obligations tied peasants to the land, to lords, and to tribute. In industrial capitalism, company stores and wage advances kept workers dependent on both the employer who paid them and the store that overcharged them. Modern consumer debt looks much cleaner, digital, legal, and generally voluntary. It comes with brand recognition, convenience, reward points, and seamless apps. But its function is actually familiar once automatic payments are in place. Debt no longer needs change. That a consumption economy propped up by debt can look stable right up until households hit their limits. First, people draw down their savings. Then they turn to credit cards. Then they split their purchases into installments. Then they delay one bill to pay another. Then delinquencies start rising. Then spending slows down. Then businesses feel the effect. Then layoffs increase. Then even more households fall behind on payments. The consumer doesn't go bankrupt all at once. They get a little weaker every month until one more bill arrives than they can handle. And the frightening part is that the system usually notices this too late. Because until payments start slipping, the spending still counts. Groceries still count. Car payments still count. Subscriptions still count. Retail sales still count. GDP figures still count. The economy shows movement, but movement doesn't always mean it isn't running out. That's why the phrase strong consumer should always be met with suspicion. Strong compared to what? Because wages are rising faster than costs? Because savings are high enough? Because debt is low and households are secure? Or simply because people are still somehow finding a way to make the payments? There's a difference between a household with income and a household that only has access to credit. There's a difference between wealth and cash on hand. There's a difference between genuine resilience and staying upright only because you're dependent on a payment system. A healthy economy runs on income. A fragile economy runs on credit. A dangerous economy runs on people who are still expected to finance a life they can no longer actually afford. And that's the real story here. This isn't a lesson about budgeting. Budgeting matters, of course, but no budget can fix a system where the cost of a normal life has become more expensive than normal wages. This isn't about shaming households either. What's actually shameful is that an economy has become so dependent on people spending money they don't have, and then everyone acts surprised when the math turns brutal. The modern consumer isn't just shopping. Carrying future obligations in their wallet, they're propping up corporate profits, retail sales, tax revenue, employment, market confidence, and GDP. When the consumer finally slows down, everyone will ask what went wrong. But the answer was already right in front of them. The economy was never really moving forward on real strength. The system was staying upright on the backs of people who couldn't actually afford to carry it. If this video gave you a new perspective, subscribe. See you in our next videos.